Bosh! My name's TradeX, this is my trading den, and today we're doing the first part of a two-part series, which is my trade management masterclass, okay? The first part is going to be about risk management and position sizing. The second part will be a deep dive into charts and how I manage trades to profit. What we need to realize is that two traders, trader A and trader B, can get into the same trade at exactly the same point, which is actually the right entry. However, trader A can only get maybe 2 ticks or even a small loss out of it, whereas trader B is able to manage that trade to profit. If that sounds familiar to you, then this series is going to be a game changer, because we're going to break down absolutely everything that you need to know in order to start trading like a professional, okay? Before we get into that, as always guys, if you find value in this video, please do consider smashing the like and subscribe. It does the channel a world of good, and it helps other viewers like yourself view this content. So without further ado, let's get the intro rolling, and then we'll jump straight into the good stuff. See you on the other side. Okay, so here we go guys, part one of my trade management masterclass. This is going to be a deep dive into this document, which is my position size and risk management calculator, okay? What I will say at this stage is, guys, if you want to get yourself a copy of this document, so if you find this valuable, I'll put a link in the show notes to my Twitter page. And if you just head to the top of that Twitter page, where it's pinned, you can download yourself a copy of this for absolutely free, okay? So the link will be in the show notes. Head over to my Twitter, pinned at the top. There you go. You have this free forever, and you can start applying it to your own trades, okay? So let's just start with a brief navigation of this document so you guys can get familiar with it. We have sheet 1 and we have sheet 2 down at the bottom. So there's 2 sheets and we're going to go through both. So let's start on sheet 2, okay? And this is kind of designed towards the person who is a futures trader and they are wanting to pass evaluations, all right? What we need to understand is that a lot of people get confused about the size of accounts that they are given from prop firms, and they think that they have 50k, 25k, 100k, whatever it may be to play with. The reality is you don't, right? What happens when you blow 2.5k? Your account's gone, right? Realistically, you are only trading with a 2.5k account if you have chosen the 50k account option. And so we need to be able to frame our risk management based off of the 2,500. Not the 50,000. I know a lot of people say, oh, well, you just use 1% of the account. 1% of the account would be 500. You know, it only takes 4 trades and you've blown your account. So a very, very quick fix to this is to take the point that we just need to be using the trading threshold as our account size. And so we can start here on the prop firm account section up here, and we can play around with these. The average is usually a 50k account, which is a drawdown of 2,500. So if you can keep within 2,500 and get up to say $3,000, which is usually your target, you pass your evaluation. We've got to therefore use 2,500 as our account size, okay? Obviously, once you pass your evaluation and say you've built a cushion of 5,000-10,000, that trading threshold becomes less of a concern. But those people who are trying to pass your evaluation, it's really, really key that we focus on the 2,500, which is your trading threshold, okay? We can then move over to this section here, and this section is really, really important. So up here, this tab here, which is G4, you can change this. So depending on what size account you have decided to sign up for, you can change this figure. So you can change it to 1,500, you can change it to 2,500. But for the sake of this episode, we're going to talk about 2,500, right? And what this is indicating is how many trades you would have to get wrong in a row to blow your account, okay? And this is going to start ringing some alarm bells for some of you guys, right? Now, what I would suggest is anywhere around sort of 7 to 8% is a good place to start, right? And that is framing your risk per trade at between $175 and sort of $200 per trade risk, right? Therefore, if you are taking the basis on a 2.5k account that you would have to blow, right? That's your ceiling. You would have to get 14 trades in a row consecutively wrong in order to blow your account. 14 trades in a row to blow your account. Now, I know some people are blowing their accounts in like 2 trades, and it's balmy. You know, all we need to realize is that if we can stick to religiously $175 or $200 per trade risk, you would have to be wrong 13 times in a row to blow your account. So now we're agreeing that we're going to work to 8%. For the purpose of this document, we're going to work to 8%. 8% is $200 risk per trade, okay? Which means you have to be wrong 13 times in a row consecutively to blow your account, right? Now, what I want to move on to is this next section, which is risk to reward. And I see a lot of people doing one-to-one Rs, and I don't get it. The reason why I don't get it is that you have to be so accurate in order to maintain profitability, which is, I understand some people have a strategy and it works for them, but I think if you want to start, trading and looking at range of trades and taking much larger profits like you see Michael doing, then you can't be operating on this one-to-one risk to reward. Now, I personally use 4-to-1R, okay? And 4-to-1R enables me to look at trades with, say, a range of 15 to 20 handles. Those of you who are inside Red Pill, you'll know that my average trade is around sort of 10 to 15 handles. And this is because I'm framing trades with a lot wider range. And then I'm paying myself, as on partials on the way to that terminus point. Now, this enables me to take profit on the way, but it also enables my accuracy to be a lot lower if needs be to maintain profitability. So with a 4-to-1 RR, if we just jump onto this chart, I only need to be right 20% of the time to be profitable. And I can tell you I'm right a lot more than 20% of the time, which is the reason why I'm so profitable. But those who are scalping or using a 1-to-1 R, you have to be right almost 60% of the time. If you start taking into account fees, it is about 60% of the time you have to be right in order to maintain profitability. Factor in that you've also got the stress of the scalping, which is, you're in, you're out, you're in, you're out, it's only feeding over trading. Then all I can suggest is look to use a wider R to R. It enables you to stay patient, waiting for the right trade to form, which has enough range for you to execute on. And when you're in your trade, you're more likely to remain patient and take partials on the way to terminus. I always say to everybody inside Red Pill, if you are not joining in with the market makers. So if you're sitting there at the charts and you ask yourself the question, are market makers likely to be joining in the market right here? And if you can't answer that question, honestly and say, yes, they would definitely be getting in at this point, then why on earth should you be, right? So I see a lot of people doing one-to-one scalps sort of mid-range, and there's no way a market maker would be getting in at that point. You're more likely, therefore, to get chopped out. You want to be in with the market makers and then play the range. And so that enables you, and you'll see the trades that happen when you get in at the right time and they just move in your direction. It's a beautiful experience, right? That's what you want to stay and remain patient for. So guys, if I can give you any advice, look for risk to rewards of at least 4-to-1 R, look for a wider range and take partials on the way up. Stop looking at this one-to-one methodology where we're just looking to take, tiny little ranges and tiny little scalps. It's not doing you any favors, and especially with indices like NQ, where we have such huge whippage, you're more than likely just going to get stopped out continuously before your trade moves to its terminus, and you're just going to get incredibly frustrated. 1-to-1 RR, all it does is encourages over trading because your anxiety, you get stopped out, you want to chase it, you want to get back in. Guys, do yourself a favor. Stay patient, take 1, 2, 3 trades a day, look for the range, and have a risk reward of 4-to-1 R. And you only need to be right 20% of the time. You only need to be right 20% of the time. So what we're going to do for the purpose of this episode, we are going to use my personal risk reward, which is 4-to-1 R with a max risk of $200 per trade. So just as a recap, we have to be wrong 13 times in a row, and we also just need to be accurate 20% of the time with a 4-to-1 R. The key here is you have to stick to this religiously. If you start changing with your risk to reward, or you start moving your stop loss because you don't want to be wrong, this is where you fall into that trap again of just being a retail trader who can't maintain profitability. If you use this document, you have to be strict with it. So write it down, stick it anywhere, put sticky notes on your computer. Whatever you decide from this document, you need to carry forward into your trading. And I guarantee, if you can stick to it for 2 weeks, you will see a marked difference in your trading and you will start to see profitability. So that is sheet 1 covered. We know what we're going to do moving into sheet 1. So let's jump into sheet 1. This is where we can start looking at trade execution. So let's take ES, because I know we have a lot of traders who are ES, who follow me on YouTube, who are also over on Twitter, who drop into my DMs now and again, and also a lot of traders inside Red Pill are also ES traders, okay? Now, what we have here is the position size calculator, okay? And so we up here we have the information that we pulled from sheet 2 across into here. So you can change this. Say you wanted the 7% option, you could change this to 175, and it changes the contract size, okay? But we agreed that 200 would be the position size that we were going to carry forward, all right? And we're trading ES. So if you are wanting to change a different indice, you can just drop down from this tab and it will change your settings here for you, okay? Very, very simple. And up here, we just have a per point. So this is what you get per point on per indice. So ES is $50 per point, right? Now, we're going to talk about ES. And what we said is that our risk is 200 per trade. So let's hypothetically talk about a trade situation. And this is where you can use this. And over time, this will become ingrained in your brain. So ingrained in your brain, insane in the membrane. That was incredibly lame. But you guys can use this position size calculator to start with, but once you start to become familiar with it, you will recognize these levels and you can just start acting on them inside the charts. Now, we are going to hypothetically say we have seen a trade which, say it's a volume imbalance, and you can see the very, very tight stop. Your stop is just on the other side of that volume imbalance, and the stop size is, 2 points, right? 2 points. This is showing you how many contracts you can take, right? Using your risk per trade that you have designated. So if you had a 2 stop on that volume imbalance, you would be able to take 2 contracts of ES. But you would not be able to move your stop loss. So if it hit your 2 stops, you'd be out of the trade, but you have fulfilled your risk management of $200 per trade. No moving the stop, not wanting to be wrong and moving it to 6 stops and getting hit, because all that is doing is completely ruining your risk to reward management strategy. All right. Now, if we are looking at the 4-to-1 R, right, we're wanting to be up at least near 8 to 10 as a target profit, right? So I would not personally take the trade unless the trade had a range minimum of about 10 handles. And then what I'd be looking to do is take one of my contracts off at, say, 6 and the other off at terminus. This is now starting to become a professional trader because you're starting to frame your trades correctly. If it comes back and takes you out, so be it. That is your risk management strategy being implemented. Now, let's say, for example, you had a much wider range. Say you were looking for 30 handles and you had a 5-point stop. Now, you would not be able to take that trade with ES because you can see the stop size here is 5, and say you're targeting 20 or 25 as a range. You could not take it with ES because you do not even have one contract, number of contracts available for you to hit that. So if it hit 5, you would blow through your risk management strategy. All right, this is where, and this is what I do, you can mix things up. So we're going to keep the 200, but we don't have enough risk money in order to fulfill that trade with ES. So what I would do is I would drop to MES, which is still S&P, but it's its little brother. All right. And you can now see with 5 stops, you can take 8 contracts of MES, right? 8 contracts of MES. And this enables you now to parlay off. So you could take 2 off at 10, you could take another 3 off at 15, if these were PD arrays which you had planned out in your trade execution, okay? This is an absolute game changer because what this is going to stop you doing is taking too many contracts of ES than you need to, and it's also going to enable you to use MES, which is to improve your risk to reward and enable you to maintain profitability. Okay, so now if we go back to ES, let's say we were looking at a trade, and I wouldn't ever suggest this, but say we were looking at 5 handles and we had a 1-point stop and we still have that 200. You would be able to take 4 contracts at a 1-point stop. So say we do 5 handle Fridays inside Red Pill because we don't want to ruin our weekends. So we will do 5 handle Fridays. We just want to get in, get out, get green, go and enjoy our weekends to get back to studying. Okay, now a 1-point stop is is maximum for me if I'm looking for 5 handles, because as I said before, I want a 4 to 1 R. But using my $200, I can take 4 contracts of that. I can take 4 contracts of ES with a 1-point stop. I'd have to be incredibly accurate, so whether that was a fair value gap, whether it was a volume imbalance bounce. I'd be looking at those sort of entries for that type of trade setup, okay? But guys, that is going to cover this episode using this position size calculator, okay? And as I mentioned before, I'll put a link in the show notes for you to grab a copy, but I hope you found that valuable. And the biggest takeaways are, I want you to start looking at a much larger risk to reward, 4 to 1, and I want you to fix your risk per trade and know what that percentage is of your trading threshold. Then you can use this table here in order to pick the right contract and stop size, and which meets your risk per trade as you've designated. Okay, guys, that is going to absolutely change the way you trade, and that is going to wrap up part 1 of this trade management masterclass. Head over to my Twitter, grab this copy, and then we'll jump into part 2, which is going to be trade management. As always, guys, if you found value in this video, please do consider smashing the like and subscribe, and until next time, I'll see you on the other side. Take care now.